In this lecture, we'll be discussing how to account for the sale of gift cards. We know that we shouldn't record revenue until we earn it, but when is the revenue from the sale of a gift card actually earned? What if there's an expiration date? What if there's not? Similar to customer deposits and warranties, cash received from the sale of gift cards results in a present obligation, not revenue. Think about what actually happens when you buy a gift card. You hand the company cash today, but the company hasn't given you any actual product or service yet. All you've got is a card, and you'll need to trade it in or redeem it before a product or service is received. So it's essentially a sale before the sale. From the company's perspective, this is not revenue yet. The earning cycle isn't complete. Although the customer has paid, the company still owes them. We call that present obligation deferred or unearned revenue. Unlike refundable deposits, though, the company doesn't have to pay the customer back in cash. Instead, they'll deliver products and services when the gift card is redeemed. Let's review the journal entries. When the company sells the gift card, it debits cash and credits deferred revenue, a liability. Notice there is no revenue at the point of sale. The company has a new resource, cash, but the claim to that resource still technically belongs to the customer, not the owners of the company. Then, when the customer redeems the card and buys merchandise, the company debits deferred revenue and credits sales revenue, effectively moving the resource claim from the customer to the owner and increasing retained earnings. The obligation has been satisfied and the revenue has been earned. Some gift cards are never fully redeemed, though. People lose them, forget about them, or leave a small balance that never gets used. In business, those unredeemed amounts are called breakage. So what does a company do with breakage? It can't just leave the deferred revenue liability sitting on the books forever. There are a few options. Companies can simply wait until the gift cards expire and then record the deferred revenue as earned. Or if the gift cards never expire, they can rely on experience and historical data to estimate the portion of the cards that will never be redeemed. We're going to keep it simple and assume that we're dealing with gift cards that eventually expire. When that happens, the revenue can be fully recognized and the liability eliminated. That's the entire life cycle of a gift card in 3 entries. Let's look at an example. This company sold $22,000 worth of gift cards. Some of those gift cards were redeemed during the year and some of them have expired. We need to record the sale, redemption, and breakage. Let's start with setting up our accounting equation. We have assets, liabilities, and equity here, and we're going to record the sale of the gift cards with a debit to cash and a credit to deferred revenue for the amount of the sale, which was $22,000. So under assets, we need a cash account. And we'll put our $22,000 debit there. And under liabilities, we need a deferred revenue account. So remember, a deferred revenue account is simply a placeholder for revenue that we're not yet ready to recognize because we haven't yet earned it. Eventually, we'll move that from that deferred revenue account into a real revenue account. And the real revenue account will increase our retained earnings. So now we can recognize some of that deferred revenue because the redemptions have occurred. So upon redemption, so this was the sale. This is going to be redemption. We'll debit the deferred revenue for the amount of gift cards that were redeemed, which was $13,000. And we'll credit sales revenue. So we're moving this claim on the resources of deferred revenue, the claims to our resources that belong to customers, we're moving that over to claims to the resources that belong to the owners and increasing retained earnings as a result. So that's the redemption of the gift cards. And then finally, we need to record the expiration of the gift cards. So expiration here, we are going to debit the deferred revenue for the remainder of gift cards. And actually, no, I'm sorry, they gave us the amount of gift cards that went expired, so $1,500. And we'll credit sales revenue. So that debit of $1,500 here leaves us with a balance in the deferred revenue account of $7,500 that will carry forward to the next year. And here's the $1,500 of sales revenue that we've recognized in the current period. Let's recap. Selling a gift card brings in cash, but the revenue has not yet been earned at the time of sale, so it needs to be deferred. Deferred revenue is a liability and represents a claim to the company's resources that belongs to someone outside of the company, in this case, the customer. That claim shifts to the owners of the company, and revenue is recognized only when the gift card is redeemed. Companies recognize revenue for gift cards that will never be redeemed, what we call breakage, based on actual or estimated expiration of those gift cards.